Over the past decade, a remarkable transformation has been taking place across the vast landscapes of rural Australia. One after another, massive cattle stations, some spanning hundreds of thousands of hectares, have changed hands, and increasingly, these iconic pieces of Australian agricultural heritage are being purchased by investors from overseas. This trend has sparked intense debate about foreign ownership, national security, and the future of Australian agriculture itself. But what's driving this phenomenon? Why are international investors so keen to own Australian cattle stations? And perhaps more intriguingly, why are some of these foreign owners now rushing to sell? The story begins with a fundamental shift in global demographics and economic power. Over the past 15 years, the rapid emergence of an Asian middle class has created unprecedented opportunities for agricultural investment. According to the Organization for Economic Cooperation and Development, Asia is projected to be home to 2/3 of the world's middle class by 2030. This shifting middle class brings with it something crucial: a growing appetite for meat and other high-quality food products. Experts forecast that global food demand will jump by 50% over the next 15 years alone. And Australia, as one of the world's largest net exporters of food, suddenly found itself squarely in the sights of ambitious international investors. For investors looking to capitalize on this trend, Australian cattle stations represented an extraordinary opportunity. These properties aren't just farms in the conventional sense. They're vast tracts of land, often spanning hundreds of thousands of hectares, with established infrastructure, proven productivity, and access to global export markets. The combination of quality land, favorable climate conditions, and a reputation for producing premium beef made Australia an irresistible target for foreign capital. The numbers tell a compelling story. According to the Australian Taxation Office, approximately 13.6% of agricultural land in Australia is in foreign hands, while the Australian Bureau of Statistics quotes an even lower figure of around 12% of farmland being foreign-owned. But the distribution of this ownership is heavily concentrated in certain sectors. The British, unsurprisingly given historical ties, emerged as the biggest foreign landholders, controlling more than 9.7 million hectares. However, the Chinese came in a close second. After a massive S. Kidman and Company sale, their total holdings jumped to 9.1 million hectares. American investors, meanwhile, own approximately 2.55 million hectares. When you examine the cattle industry specifically, the picture becomes even more concentrated. Academic research has revealed that the vast majority of foreign land ownership in Australia, on a land area basis, results from the activities of just 10 corporate cattle companies. These aren't scattered small holdings or boutique farms. These are massive, integrated agricultural businesses with multiple properties spread across different regions. Shanghai Zhongfu Group, operating through its wholly owned subsidiary Kimberley Agricultural Investment, provides a perfect example of this scale of operation. This single Chinese company has bought and leased approximately 500,000 hectares of farmland in the East Kimberley region, including the massive Carlton Hill cattle station, which spans 476,000 hectares. To put that in perspective, Carlton Hill alone is larger than some small countries. Other foreign investors have pursued similarly ambitious strategies. Malaysia's Sarawak Economic Development Corporation, for instance, has maintained ownership of Rosewood Station on the NT and Western Australia border for 35 years, demonstrating a commitment to long-term agricultural investment. Yet, as we move into 2024 and 2025, something remarkable is happening. The narrative has shifted. Instead of stories about foreign investors eagerly snapping up Australian agricultural assets, we're now seeing a wave of foreign-owned properties being liquidated. Chinese investors, in particular, are engaging in what industry experts describe as a net sell-down of farm assets. This transformation didn't happen overnight. Industry contexts suggest that the sell-down of Chinese-owned agricultural assets has been occurring for a couple of years, but it appears to have gathered significant momentum throughout 2024. And the reasons behind this reversal are as complex as they are revealing. The primary driver of this shift points directly to economic pressures within China itself. As the Chinese economy has struggled with slower growth and reduced consumer spending, overseas investors have found themselves under increasing pressure to raise capital. Cash that had flowed freely into foreign ventures just a few years ago is now needed closer to home. But the economic situation in China represents only part of the story. There's another factor that's been equally, if not more, damaging to foreign investor sentiment: Queensland's punitive land tax regime. Beginning several years ago, Queensland implemented state land taxes, specifically targeting offshore-based landowners who hold significant farmland assets. For foreign investors managing vast properties worth hundreds of millions of dollars, these land taxes have added millions to their annual operating costs. To understand the impact, consider a foreign investor holding a property portfolio in Queensland. Year after year, the land tax bills mount. These aren't trivial. amounts either. Industry sources report that in some cases, state land tax has been adding millions to annual costs for offshore owners, to the point where the properties have become considerably less attractive from an investment perspective. When your annual tax burden climbs into the millions of dollars, even a property that's otherwise profitable can start to look like a poor investment. This tax situation has created what rural real estate agents describe as a major sovereign risk concern. From an investment perspective, sovereign risk refers to the chance that a government will change rules or policies in ways that are unfavorable to foreign investors. When Queensland introduced these targeted land taxes, it sent a clear signal to international investors. The rules of the game were changing. Brisbane-based rural fund manager Tim McGavin has been particularly vocal about the damage done by Queensland's land tax regime. McGavin, the managing director and founder of Laguna Bay, recently told the Global Food Forum in Brisbane that investors who would normally want to invest in Queensland were now eyeing alternative locations in southern Australian states, or even different countries like New Zealand altogether. Beyond state-level taxes, foreign investors have increasingly found themselves facing a more complex regulatory environment at the national level as well. Changes to Foreign Investment Review Board regulations have made the approval process for significant agricultural purchases more uncertain and time-consuming. But there's more. The Australian Competition and Consumer Commission, or ACCC, is now automatically scrutinizing transactions of substance. In the past, approximately 2,400 mergers and acquisitions events occurred annually in Australia, with roughly 850 of those being referred to the ACCC for examination. However, from 2025 onward, all 2,400 of these events are now required to gain ACCC approval. This represents a substantial increase in regulatory burden and uncertainty for foreign investors. When you combine economic pressures at home, punitive land taxes, regulatory uncertainty, and increased transaction scrutiny, the appeal of holding Australian agricultural assets begins to diminish significantly. Foreign investors who were once aggressive purchasers are now reconsidering their portfolios. And some have decided that the best course of action is to liquidate their holdings while market conditions remain relatively favorable. The concrete evidence of this shift is visible across Australia in specific property transactions. Let's start with the Van Dairy Limited portfolio in Tasmania. This collection of dairy and farming properties had been progressively built up by Chinese businessman Shanfeng Liu over the years. In 2022, Liu sold 6,000 hectares of country, originally part of the Woolnorth aggregation, to the family-owned TRT Pastoral Group for $120 million. But that was just the beginning of the breakup. In March 2024, another 700-hectare portion in Tasmania's fertile northwest region was sold for $15 million to a Melbourne-based asset fund. These weren't transactions conducted hastily or at fire sale prices. Rather, they represented a measured unwinding of a portfolio by an investor who apparently decided that the time had come to move capital elsewhere. Similarly, in Western Australia's Kimberley region, Hui Wing Mao, the founder of Hong Kong property developer Shimao Group, sold the massive Argyle portfolio. This wasn't a small operation. We're talking about 2.9 million hectares changing hands. This represents one of the largest individual property transactions in Australian agricultural history. The scale of such sales indicates that these aren't marginal investors reconsidering minor holdings. These are major international investors fundamentally reassessing their commitment to Australian agricultural assets. The Curnout Dairy Farm situation in Victoria presents another instructive example. Ningbo Dairy Group, operating through its Chinese subsidiary Zhejiang Nanyuan Holding Group, had established Australian Yoyu Dairy back in 2012 to purchase and operate dairy farms in Gippsland. The company acquired 3 farms in the Tenby Point area near Coronella and 2 additional adjacent farms at Curnow, which included 520 milking cows. However, reports suggest that part of this business was recently sold to a Melbourne high net wealth investor for $7 million, representing another piece of the broader pullback by Chinese interests. Meanwhile, Vietnamese-owned Vermella Station in the Northern Territory has been making headlines as another foreign-owned asset being brought to market, potentially commanding more than $40 million. These aren't isolated cases. When rural real estate agents across multiple states were contacted and asked about foreign-owned properties currently listed for sale or under contract, they readily identified 8 large foreign-owned properties spread across 3 states and territories. The total land area represented by these listings approaches 1.1 million hectares. That's a staggering amount of property in the process of being repatriated to Australian ownership. However, it's important to note that while foreign investors have been selling, there's simultaneously been a significant amount of foreign capital continuing to flow into Australian agriculture. This suggests that the market is experiencing a rotation rather than a complete withdrawal. The most prominent recent example is the Worrell Creek aggregation sale near Goondiwindi in Queensland. This massive property was particularly significant because it represented one of Australia's largest privately owned irrigation and dryland farming operations. The entire aggregation changed hands for an estimated $300 to $350 million, making it arguably the biggest farm sale in Australia during 2024. The purchasers in this case were notable. Melbourne-based Warrakirri Asset Management partnered with US-backed Alkira Farms, which is a subsidiary of US agricultural investment giant Farmland Reserve. The Worrell Creek property comprises 7 individual properties and includes an astounding 65,900 megaliters of water entitlements. The vendors, Robert and Jenny Reardon, had spent more than 3 decades developing the aggregation into the major operation it had become. The transaction was facilitated through a combination of Warrakirri's local Australian expertise and Farmland Reserve's international capital resources. This sale illustrates an important point. While Chinese investors and some other foreign players are reducing their holdings, American investors and other international players continue to view Australian agriculture as a compelling opportunity. Another significant 2024 transaction involved the mainland and Bomba Plains properties near Rolleston in Queensland. These 2 properties, comprising 6,622 hectares, were partially sold for $39 million to the New York-based investment firm, the Rohatyn Group. Under the terms of the deal, Rural Funds Management retained a 50% stake, while the Rohatyn Group and a global institutional investor leased the properties under a 10-year triple net lease agreement. Mainland had been acquired by the Rural Funds Group in 2018 for $18 million, while Bomba Plains was purchased in 2021 for $32 million and includes 20,733 megaliters of water entitlements. The Gettonville holding near Bowen in Queensland sold for more than $70 million and represents another instructive case study. This 62-year-old cattle property is renowned for breeding and finishing premium bullocks and cull cows. The holding encompasses 7,500 adult cattle equivalent capacity and was offered on a walk-in walk-out basis, including a 4,900 head Santa Gertrudis cattle herd, water rights, and extensive plant and machinery. The property features a 5-bedroom homestead, modern infrastructure, and frontage to the permanent Bowen River. The sale transferred the vendor's HK1 stock brand to the new owner, underscoring how these transactions often involve transferring not just physical assets, but also established brand equity and market position. Now, throughout this discussion of foreign investment in Australian agriculture, one transaction looms particularly large: the attempted sale of S. Kidman and Company. This company represents Australia's largest private landowner and represents approximately 1.3% of Australia's total land area and 2.5% of agricultural land. The company operates 10 cattle stations spread across regional South Australia, Western Australia, the Northern Territory, and Queensland. These stations cover 100 to 1,411 square kilometers and manage a long-term average herd of 185,000 cattle. In 2016, when this iconic company came up for sale, it attracted significant interest from Chinese investors. Local reports suggested that 2 Chinese investment companies were engaged in a bidding battle for the assets. However, the Australian government stepped in and blocked the sale. Treasurer Scott Morrison determined that it would be contrary to Australia's national interest for a foreign person to acquire S. Kidman and Company in its current form. Morrison's statement identified 2 key factors in this decision. First, there was the sheer size and significance of the total Kidman portfolio. A single foreign investor or entity would acquire control of agricultural assets, comprising more than 1% of Australia's entire land area. That represented a concentration of assets that raised legitimate questions about market concentration and Australia's long-term agricultural independence. Second, and perhaps more significantly from a national security perspective, Anna Creek Cattle Station, one of the Kidman properties, is 50% located in the Woomera Prohibited Area, or WPA, in South Australia. The WPA is not just any restricted zone. It's home to a sensitive weapons testing range where Australia conducts crucial military and defense experiments. Having a foreign owner controlling land within or overlapping this prohibited area raised serious national security concerns. Morrison made clear that while Australia would continue to welcome and support foreign investment that is not contrary to national interest, this particular transaction crossed that line. The Kidman decision established important precedent and raised important questions about the appropriate scope of foreign ownership in Australian agriculture. While the decision was framed in terms of national security, it also implicitly raised questions about whether there should be overall limits on the concentration of foreign ownership in any single agricultural sector. The incident has reportedly made some foreign property owners and investors uneasy about the possibility of changing government and subsequent changes to foreign investment rules more broadly. As we examine the current market dynamics, it's important to understand what's actually driving demand for cattle stations beyond foreign investment. Domestically, Australian cattle stations have attracted increasing interest from high net worth individuals and established Australian business figures. Names like Gina Reinhart, Andrew Forrest, Kerry Stokes, and Brett Blundy have all acquired substantial cattle properties in recent years. According to Rural Real Estate Professionals, there are increasingly more domestic bidders than foreign bidders showing up to auctions of larger cattle assets. This shift reflects several factors. First, record cattle prices in the past 18 months have made these assets look increasingly attractive. Second, uncertainty around foreign investment policy has made foreign buyers more cautious. Third, successful Australian entrepreneurs and industrialists are increasingly viewing premium cattle stations as both viable business investments and desirable lifestyle acquisitions. The underlying economics of large-scale cattle operations remain sound. Australia's beef production and exports are forecast to reach record levels in 2025, building on record export results achieved in 2024. This production surge has largely been driven by strong demand from the United States, which experienced its own cattle supply shortage. American demand has been so strong that the U.S. has become Australia's largest beef export market. The projected record production and exports for 2025 are largely due to an elevated female slaughter rate, which will require careful management to ensure that the breeding herd can be sustained going forward. Meanwhile, the live cattle export market to Asia remains important, though competition from Brazil poses a potential future disruption. In China and Southeast Asia, demand remains robust, though consumers have suffered from weaker purchasing power caused by higher living costs. Since red meat is considered a premium protein with a higher price point compared to alternatives, the consumption dynamics have been impacted and are recovering more slowly than anticipated. However, in the medium term, notable developments suggest continued strong demand. Indonesia, in particular, is experiencing a decline in cattle population, largely due to disease outbreaks, and this is expected to heighten demand for imports of Australian cattle for fresh meat to bridge the beef supply gap. The financial returns from cattle operations have also improved dramatically compared to historical patterns. Historically, Australian family farms have earned negative rates of return from farm incomes over the past 20 years. That is to say, they have not earned sufficient money to justify their value as a financial asset. However, corporate-owned cattle properties, which tend to be geographically diverse with multiple properties across different regions, have demonstrated significantly better financial performance. This geographic diversity provides important advantages. Drought management is one of the key challenges faced by the grazing industry, and ownership of multiple properties across different regions allows integrated businesses to reduce environmental impact during drought periods. Corporate properties are less likely to overstock during difficult periods, whereas small pastoralists experiencing financial hardship are often under more pressure to push their herds to unsustainable levels. Looking at the current cattle industry from a production perspective, the numbers are instructive. The national cattle herd has reached and passed a cyclical peak after operating at maturity for the past 12 months. The national herd is expected to ease by 1.4% to 30.2 million head in 2024, a decline of slightly over 400,000 head. In 2025, the herd is expected to fall another 2% to 29.5 million head, and ease another 3% in 2026 to 28.6 million head. By 2026, forecasters project that the herd will be 6.3% smaller than the cyclical peak observed in 2023. Under the assumption that climatic conditions follow average trends, 2026 is likely to be the end of the destocking phase, after which the industry would begin rebuilding herd numbers. These production dynamics have important implications for land values and investment opportunities. When cattle prices are strong and production is robust, agricultural land values tend to appreciate. Historically, land values have followed the cycle of commodity prices quite closely, with cattle prices having reached historically high levels in the past 18 months, both in the live export market and in the domestic market. There has been substantial interest from property buyers. This creates a window of opportunity for existing owners who want to exit their positions. If you're a foreign investor who has become uncomfortable with the regulatory environment or who needs to raise capital due to home country economic pressures, the current market presents an attractive moment to sell at strong prices. Conversely, the situation creates attractive entry points for buyers who believe in the long-term fundamentals of the Australian cattle industry. The strong commodity prices, combined with expected continued demand from Asian markets in the medium term, suggest that there will be ongoing opportunities for profitable cattle operations. This helps explain why we're seeing both substantial foreign sell-offs and continued foreign investment activity simultaneously. Some foreign investors are exiting while others are entering, and Australian investors are increasingly active buyers. When we examine the actual mechanics of foreign investment in Australian agricultural property, The process involves navigating the Foreign Investment Review Board, or FIRB. FIRB operates under the guidelines established by Australian law to screen foreign investment proposals. The board assesses whether proposed investments are in Australia's national interest. In agricultural land transactions, FIRB considers factors including the size of the transaction, the strategic importance of the land, the operational plans of the foreign investor, and broader foreign policy considerations. The Kidman case demonstrated that even massive offers and serious investors can be blocked if the national interest test is not satisfied. David Irvine, the chair of the Foreign Investment Review Board, has stated that despite community agitation about foreign ownership of Australian farms, foreign ownership has remained at relatively modest levels, at least on a percentage basis. The approximately 12 to 13% of the farmland owned by foreigners is substantial in absolute terms, but represents a minority of agricultural land. Irvine has also noted that foreign investment in Australian agriculture has provided enormous benefits and will continue to do so in the future. However, the debate around foreign ownership has become increasingly politicized, particularly with regard to Chinese investment specifically. The reasons for political sensitivity around Chinese investment are multifaceted. First, there's the sheer scale of the increase in Chinese land ownership. In a relatively short period of time, Chinese investors moved from minimal holdings to holding approximately 9.1 million hectares of Australian agricultural land. Second, there's the strategic nature of food security. While Australia itself faces no food security threat from foreign ownership, the idea that foreigners might control significant portions of Australia's food production capacity generates genuine concern among some segments of the public. Third, there are broader geopolitical tensions between Australia and China that have colored discussions about Chinese investment more generally. However, it's worth considering these concerns in perspective. To exercise meaningful control over Australia's beef production, a foreign investor would need to secure at least 15% of production capacity. Australia's current cattle herd is around 26 million head. 15% would mean a herd of close to 4 million cattle. Australia's largest beef producer, the Australian Agricultural Company, operates a herd of only 670,000 cattle with gross assets of around $1.2 billion. To acquire 15% of national beef production capacity, a foreign investor would need to spend approximately $6.6 billion. Even then, they would only hold 15% of the market, and it would still face major competition in global markets with limited capacity to influence global beef pricing. From a market distortion perspective, the concern seems equally overstated. Australia is one of the world's largest net exporters of food. Global commodity markets for agricultural products are large and deep. Individual producers, even very large ones, all have limited ability to influence global prices or limit market access. For cattle, the key price determinants are global demand, feed costs, and currency movements. A single foreign investor, no matter how large, cannot meaningfully manipulate these fundamental drivers. It's also worth noting that Australia operates one of the most liberal and open policies for foreign agricultural investment anywhere in the world. Many U.S. states do not allow any non-resident to own land. New Zealand scrutinizes any foreign purchase of more than 5 hectares of land, requiring approval from its Overseas Investment Office. Foreign ownership of farmland is completely illegal in China. In Brazil, foreign ownership of farmland is largely impossible. By comparison, Australia's approach has been quite welcoming, subject to FIRB screening for significant transactions. Looking forward, the trajectory of foreign investment in Australian agriculture will likely depend on several factors. Economic conditions in source countries, particularly China, will influence whether overseas investors feel pressure to repatriate capital. Regulatory and tax policies within Australia, particularly at the state level, will determine the after-tax returns available to foreign investors. Global cattle prices and demand from Asian markets will affect the fundamental attractiveness of agricultural assets, and geopolitical developments may influence the political appetite for further foreign investment in Australian food production. The rotational nature of foreign investment in Australian agriculture suggests that we're unlikely to see a complete pullback of overseas capital. Instead, we're seeing what appears to be a reallocation where some investors exit while others continue to enter, and where the sources and compositions of foreign investment shift. Chinese investors appear to be reducing their holdings for a combination of economic and regulatory reasons. However, American investors continue to be active, and other international sources of capital remain engaged. Meanwhile, Australian investors, particularly high net worth individuals and established business figures, are becoming more prominent participants in the cattle station market. In conclusion, the story of foreign investment in Australian cattle stations is not a simple narrative of rising or falling overseas involvement. Rather, it's a complex story of shifting global economics, regulatory changes, market cycles, and strategic decision-making by investors of different origins. The rapid expansion of foreign investment over the past decade reflected genuine economic fundamentals, growing Asian demand for food, attractive returns from Australian agricultural assets, and abundant overseas capital seeking investment opportunities. The subsequent pullback by some foreign investors reflects equally genuine changes, economic slowdowns at home, regulatory uncertainty, new tax burdens, and market timing decisions by investors taking profits after periods of strong appreciation. The broader implications of these trends extend beyond the cattle industry itself. They raise important questions about the appropriate balance between welcoming foreign capital and protecting national interests. They highlight the importance of having clear, stable, and fairly applied regulatory frameworks that treat foreign and domestic investors equitably. And they underscore the reality that agricultural investment, like all investment, responds to changes in profitability, regulation, and risk. Australian cattle stations will continue to attract both foreign and domestic investors as long as the industry remains fundamentally sound. The current market dynamics suggest that we're entering a period where Australian investors will play an increasingly prominent role in directing the evolution of the cattle industry, even as foreign investors maintain significant holdings and continue to deploy capital into selected opportunities. The vast cattle stations that dot Australia's inland landscape will continue to change hands, adapted to new ownership structures and management approaches, but remaining central to Australia's agricultural identity and export economy. The question is not whether foreign investment will continue, but rather how it will be shaped by regulatory choices, market forces, and the strategic decisions of investors on both sides of Australia's borders.